All right, today we're going to take a calm, rational look at four software giants: ServiceNow, SAP, Workday, and Oracle. Now, our goal here isn't to pick a stock, it's to answer a much more fundamental question: which of these businesses is actually built to be the strongest long-term compounder? So, let's dive in.
When you look at these four, you're really seeing a clash of different business philosophies. On one hand, you've got the pure growth innovators, and on the other, you have the massive incumbents who are leaning on decades of durability. So the real question for us is, which of these models actually creates the most resilient, lasting value in the long run?
Okay, so to get to an answer, we're going to use a pretty straightforward framework. First, we'll dig into their core economic engines. Then, we'll look at their defenses, their moats. After that, we'll check out their capital discipline, stress test each model for fragility, and then, bring it all together for a final judgment. So before we even start talking about things like moats or growth rates, we have to get under the hood and understand the economic engine of each company. Is it a high-performance machine that just hums along, or is it something that needs constant, really expensive maintenance to keep running? And ServiceNow, well, this is pretty much the textbook example of an ideal modern software model. Almost everything, we're talking 97%, is from subscriptions. That means predictable revenue and, more importantly, incredible operating leverage. And what that means is, as they get bigger, more and more of every new dollar of revenue drops straight to the bottom line. It's just a beautiful self-funding engine, which lets them pour money back into R&D without having to go out and borrow. Now, SAP. On the surface, this looks really strong too, right? A huge chunk of their revenue is recurring. But, and this is a big but, there's a critical nuance here. They're smack in the middle of this massive, complicated transition. They're trying to move customers from their old, super high-margin support contracts over to their new, lower-margin cloud products. So even though the revenue is recurring, the quality of that revenue is actually facing a bit of a structural headwind. Okay, and with Workday and Oracle, you see two completely different strategies playing out. Workday is a lot like ServiceNow. It's a pure-play, high-quality SaaS business. Its real strength is its intense focus on human capital management. That focus is its power, but it also, defines its scope. It's a narrower field. Oracle, on the other hand, is doing something really dramatic. They're pivoting away from that asset-light software model and going all in on a capital-heavy cloud infrastructure business. It's like they're trying to change their entire economic DNA. So if you take one thing away from this first part, it's this: capital intensity. That's what really separates these companies. You've got ServiceNow and Workday with these beautiful asset-light models that just print cash, but they do depend on continued growth. Then you have Oracle, which is basically sacrificing that model to go build a ton of data centers. And SAP? Well, they're kind of stuck in the middle, trying to use their old cash cow to fund their big transition. Having a great economic engine is one thing, but how durable is it really? How well is it protected from competitors who want a piece of the pie? This is where we have to talk about the company's defenses, what people call its economic moat. And in the software world, probably the most powerful moat you can have is high switching costs. Think about it. It's the sheer pain in terms of time, money, and just operational chaos that a customer would have to go through to rip out one system and plug in a new one. When those costs are really high, a company has a lot of power to protect its pricing and its profits for a very, very long time. And this really lays out the pecking order pretty clearly. Based on this analysis, you'd have to say SAP has the strongest moat. Their software is just so deeply embedded into the core operations of the world's biggest companies. Trying to remove it would be like performing corporate open-heart surgery. It creates this incredible lock-in. But, and there's always a but, there's a trade-off here. Right, so that incredibly powerful moat, it hasn't exactly gone unnoticed. SAP is actually facing some regulatory heat over in Europe about how it uses that dominant position, especially around its support contracts. And this is a really important point. Even the strongest moat can be weakened by outside forces. It creates a very specific risk that has absolutely nothing to do with how good the product is. Thinking about that potential risk to SAP's moat brings up our next crucial point, which is management's behavior. We've looked at the engines and their defenses. Now let's look at what management actually does with the money these businesses generate. Because, a company's true priorities are always revealed by where it puts its cash. And wow, this number is just staggering. To fund that big pivot to cloud infrastructure, Oracle's free cash flow, the actual cash left over after paying for everything, was a negative $13.2 billion over the last year. This is a massive, massive bet, and it's funded with debt. That, by definition, introduces a huge point of fragility into the business model. And then you see this, which is the complete polar opposite. ServiceNow's asset-light model just churns out cash, over $5 billion from operations, which more than covers what it needs to grow. This is exactly what self-funded growth looks like. It's a position of incredible strength, and it gives them a ton of strategic flexibility that companies loaded with debt just don't have. Okay, so this all brings us to a really simple but powerful stress test. Let's ask this question. What happens if the single most critical assumption for each company turns out to be flat out wrong? How gracefully does the business model hold up? This is what reveals the real difference between a resilient company and a fragile one. So for ServiceNow, the fragile assumption is that its heavy concentration with a single federal partner is totally fine. For SAP, it's the assumption that their huge backlog of customers will actually stick with them through a really messy cloud transition. With Workday, the bet is that its top-tier HR software can hold its own against bigger competitors who are bundling HR into their platforms. And for Oracle, well, the entire bet rests on those enormous infrastructure contracts actually turning into high-return cash flow somewhere down the line. So what's the result when we apply that pressure? The analysis suggests that Workday, with its simpler, more focused model, actually degrades the most gracefully. If growth slows down, they don't have these huge unrelated costs to deal with, so the core business stays pretty stable. And at the other end of the spectrum, you have Oracle. It's the most fragile. All that leverage and the massive fixed costs mean that if that future cash flow doesn't show up, the downside gets amplified in a big way. All right, we've looked at the engines, we've sized up the moats, we've checked their capital discipline, and we've tested for fragility. Now it's time to put all the pieces together and arrive at a final judgment. Now, I want to be clear, a table like this isn't some kind of crystal ball. It's not meant to predict the future. But what it does do is force us to be disciplined, and it visualizes the synthesis of our entire analysis. And when you look at the patterns here, you can see a really clear separation in quality, based on the criteria we've been talking about. It's not a close race at the top. And you can see ServiceNow consistently scores at or very near the top in pretty much every single category we've looked at, from the purity of its business model to its financial strength, all the way to the quality of its growth. It just demonstrates this remarkable consistency all the way through. So if we're basing this strictly on a comparative analysis, ServiceNow really does present the strongest all-around case. It manages to combine the scale of an industry giant with the superior economics of a pure SaaS business, and it's still delivering strong growth and expanding its margins. In many ways, it's the complete package. Now, that's not to say the others are bad businesses at all, but each of them comes with a pretty significant but. SAP's incredible moat is kind of clouded by the risk of its big transition. Workday is a really clean, resilient company, but its sharp focus also makes it a narrower target. And as for Oracle, well, that ambitious transformation just carries too much debt and too much execution risk to clear the high bar we've set for a durable long-term compounder, at least for now. So let's just end with a final question to keep in the back of your mind. What's the one variable that could change this whole conclusion? For me, the most likely candidate is SAP. If, and this is a really big if they can somehow navigate this complex cloud transition over the next few years without taking a major hit to their margins and without getting into more regulatory trouble, well then the sheer raw power of their entrenched moat could absolutely present a serious challenge to ServiceNow. That right there is the key variable to watch.